Hello traders. Today I want to share with you the most important thing that made me a profitable forex trader. The most important thing that made me a profitable forex trader. If you do these things I'm about to share with you, you become instantly profitable in your forex trading career. If you do what I'm about to share with you right now, you will become an instantly profitable forex trader. You will become instantly profitable forex trader. In fact, this could be the missing link in your becoming a profitable forex trader. All right, so you need to watch this video till the end. Watch this video till the end. This could just be the missing link in your becoming a profitable forex trader. When I started doing this, my forex trading career changed for the better. All right, even this week you can see in our forex telegram group, we killed the market. We basically ripped the market. We killed the market this week. So if you want to know how we did that, so just stay put and view this video till the end. All right, so now the most important thing, the trading game changer for me was when I started thinking in probabilities. When I started thinking in probabilities, that was this trading game changer. I have made some videos before now which I highlighted this as one of the keys to becoming a profitable forex trader, thinking in probabilities. But today I want to share with you actually in details how you can actually think in probabilities and how you can harness the power of probabilities in becoming a profitable and a successful forex trader. So that was actually great. So without thinking in probabilities, you get frustrated with trading. Without thinking in probabilities, you will actually get frustrated in trading. The reason is because trading results are random in the short term but predictable over a large chance sample of trades. Trading results are random. No forex trader in the planet, can tell you whether the next trade he's going to take is going to be a win or a losing trade. No forex trader in the planet can tell you for sure with 100% assurance that any trade he or she is going to take is going to be a win or a loss. Okay, but he can tell you that at the end of every week or at the end of every month he's going to come out profitably. Okay, I hardly have a losing month. Even I hardly have a losing week. I can have a losing day, okay, but hardly will I have a losing week. A losing month is almost non-existent. All right, so why? Because of the power of probabilities. Okay, I can lose a trade today, but at the end of the week I am almost sure to come out with a net profit. I can lose a trade in a day. Okay, I can lose 2 trades in a day, but at the end of the week or even a month, I can guarantee you almost with 100% certainty, almost 100% certainty that I'm going to be profitable. All right, so that is, I want to share with you how it works. I want to share with you how it works in details today. So this is very important. Do not stop viewing this. Just watch to the end. Watch to the end. These few minutes could be the game changer for you, just as it has been for me in my trading career. All right, so thinking in probabilities gives you a good psychological mindset necessary to becoming a profitable and professional and successful trader. Okay, thinking in probabilities gives you a good psychological mindset necessary to becoming a professional and a successful forex trader. So this solves most of your trading problems, and the absence of this concept in your trading is mostly the root cause of the problems you face as a trader. All right, so when you lack the probability mindset, you get frustrated, you risk too much. Okay, you increase your loss sizes, you risk too much, you get disappointed, you get afraid of losing trades. No, if you have the probability mindset all the time, in every day you approach the market from a probability standpoint, you will not be afraid of losing trades. The fear of losing trades disappear when you start thinking in probabilities. All right, probably the forex business is a probabilities business. All right, it's a game of numbers. As we proceed in this video, I'm going to show you in details how this works. It's a game of numbers, and it's a game of mathematics, probabilities, simple pure statistics and probabilities. If you know how to play the numbers game, you will surely be a profitable forex trader. It's a numbers game. Just win more than when you lose. Make more money when you lose, when you win, than when you lose. you are guaranteed to become a profitable forex trader. When you make more money when you win trades than when you lose trades, that is the simple math. That is the simple mathematics. But many traders do not know how it works. Okay, so I'll be showing you how it works in details now. So how to understand and use the concept of probabilities in forex trading. How do you understand it? So I want to show you in details how you can understand and use the concepts of probabilities in forex trading. All right. Now, okay, so now the concept of probability in forex trading is based or linked or is hinged on the principle of large numbers. Okay, trading results obey the principle of large number, which we call LLN. Okay, the principle of large numbers. That is the this is what trading results is hinged on, and this is what helps the probability game in trading. The law of large number. What does the law of large number say? The large number says that in forex trading there is a random distribution between wins and losses in a short term, but in a large sample of trades, the probabilities begin to work, which is the law of large numbers, also known as the LLN. Okay, in forex trading, there is a random distribution between wins and losses in the short term, but in a large sample of trades or large sample size, the probabilities begins to work. The probabilities begin to work. All right, so it is on this principle that professional forex trading is hinged. It is on the principle of large numbers and probability that professional forex trading is hinged. You will get frustrated if you don't work with probability, because you would want to risk high in some certain times. A few times you get away with it. The market, you get away with it. You increase your loss size. You make a quick gambling kind of profit. But each time you increase your loss size, and each time you increase your risk, you discover that your heart is pounding. You discover that you are stressed out. You discover that you cannot sit. Your blood pressure rises. Is that what you want to do for the rest of your life? Is that what you want to do for the rest of your life? You want to have high blood pressure trading? No. Trading is not gambling. Trading is a business. It is not fun. It is a business. It is not a hobby. It is a business and should be treated as a business without rise in your high blood pressure, sporadic rise and fall of your blood pressure. No. How long would you want to do this? If you want to do this trading like me, that want to do this till I retire, for over the next 10, 50, if up to 50 years, 30, 40, 50 years ahead, if you want to do this, you want to have a principle in place that guarantees you're making money without stress. And if you want to make money without stress in the forex trading market, you have to learn the principle of probabilities, and you have to start taking forex trading as a business and not as fun or a hobby. Okay, so the principle of large numbers says that trading results are predictable. Trading results are random over a short sample of trades, but predictable over a large sample of trades. Let's see how it works. Okay, so now the best example of how the law of large numbers work can be seen when you toss a coin. Okay, when you toss a coin, you can see how you see how it works. Let me show you the results of a toss coin. When you toss a coin, you can see the first two tosses could be losses. Okay, now when you toss a coin, you have heads and tail, right? When you toss a coin, you either have a head or a tail. When you toss a coin, right, you have a head or a tail. Okay, so there's a 50% probability that when you toss a coin, you're going to have a head or a tail. There's a 50% probability. But when you toss it a few more times, the outcome becomes totally random. If you toss a coin once, you either get a head or a tail, which is a 50% probability. But when you toss it like 10 times or 5 times, you can have 5 heads or 5 tails, or you can have 3 heads or 2 tails. It's random. But when you toss a coin for 100 times, more times you toss a coin, the probability comes closer to 50% on each. Okay, you either have almost 50% heads and almost 50% tails. All right, like you can see in this case now, Okay, now you can actually see in this case now the first two tosses gives you, let's assume that the bad here, the X, let's assume that the X here means head, so two heads. The next one gave a tail. Now you see six heads in a row, which is a loss. Okay, now a tail, assuming we are using a loss, the tail as a win. Now there are two wins here, which two wins. Okay, now you can see here four heads, four losses, one win. You see, it's random. It's random. Okay, this is a losing streak. This is two winning streak. These are five. These are six losing streaks, five winning streaks, and so on and so forth. Here now look at losing streaks here, about up to 4, 5, 6, 7, 8, 9, 10. 10 losing streaks here, and winning streaks. So trading results are random. Now, when you calculate the number of wins and losses here over this large sample of trades, you would get almost 50%. Okay, when you calculate the number of wins and losses over this large sample of trades, you get almost 50%. You get almost 50%. All right, you get almost 50%. So that is the law of large number. That is how it works. We're going to go into details more. Okay, we're going to go into details about this more. Now you can see that. So two most important considerations while using the law of large numbers. There are two important considerations that you're going to put into two most important things to think about, or that helps the law of large numbers to work. Number one is position sizing. Okay, position sizing. So you must make sure that you use the correct position size no matter what, or the law of large number will not work. Just like in this case now, in this area, in this example, let's assume that each time you lose $1. Each time you win $2. Okay, each time you win, let's assume that each time you lose, which is X here now, each time you lose, you lose $1, and each time you win $2. Okay, now if you do that, you can imagine that if you lose 45 times, if you lose 55 times and win 45 times, you discover that you would have made more money when you subtract your gross win from your loss. You discover that you have a net profit. Okay, so each time you win $1, you win $2, and each time you lose $1 consistently. If you do this consistently, you discover that when you subtract your losses from your win, let's assume you win 50 times and lose 50 times. If this were to be 100 trades, okay, if you lose 50 times, you've lost $50 out of 100 times, right? Now each time, if you win $2 each time you win, and you win 50 times, which is 50%, that means you would have won $100. Okay, so $100, now $50 that you lost out of the 100 trades minus the $100 would have given you a $50 net profit. All right, so regardless of the fact that you had losing streaks on these occasions, you will still come out with a net profit after a large sample of trades, typically 100 trades, mostly 100 trades. You will still come out with a net profit. Each time you win $2, which is times 2 of your loss, which is 1:2 risk to reward ratio, and each time you lose $1. After 100 trades with a 50% win rate, you would have made $50 after 100 trades, approximately. All right, so over time you'll be profitable, and this is exactly how the law of large number works. This is how experienced and professional forex traders approach the market. They don't approach the market with the mindset of making it once. Trading is a get rich slow scheme, not a get rich quick scheme. Trading is a get rich slow scheme, not a get rich quick scheme. So if you do not risk consistently $1 in each of these trades, you mess it up. You mess up your statistical edge. Let's assume here you risked $5 and here you risk $1. This will not work. You have to risk consistently the same amount. If you want to risk $100 per trade, like for example, currently I risk in the account I'm currently trading, I risked $1,000 per trade. Okay, it's a prop account, prop firm account. I risked $1,000 per trade. Okay, so for you now, you might be trading a small account, maybe a can account of maybe like $100 account. Okay, you should risk $1 per trade, which like 1% at least, or max. Or you are trading a $1,000 account, you should risk like $10 per trade, which is like 1% of that account. So, but if you increase your lot size and you risk more, you risk randomly, you don't keep consistent risk per trades here. This statistical principle of probability is not going to work for you. Okay, this statistical principle of probability is not going to work for you if you do not keep your risk constant. So let us proceed. So while we're talking about the two considerations that you need to keep in place while obeying this principle, while trying to allow the principle of large numbers to work for you. And we said that number one is that position size, and you must make sure that you use the correct position size no matter what, or the law of large numbers is not going to work. Second principle is the gambler's fallacy. You need to avoid the gambler's fallacy. Okay, you need to avoid the gambler's fallacy. What is the gambler's fallacy? The gambler's fallacy is the mistaken belief that if an event occurred more frequently than expected in the past, then it's less likely to occur in the future, and vice versa. In a situation where these occurrences are independent of one another. Now, what does this mean? The gambler's fallacy means that it means that some people feel that when they have had like 2-3 losses in a row, that the next trade is going to still be a win, and in that case they would want to increase their lot size, increase their risk in order to recover all their previous losses. No, if you increase your risk, you could still have a losing trade. You do not know. Results are random. Now, there is also a mistaken belief that if you've had like 3 or 4 winning trades in a row, that the next trade is likely to be a loss, and then you reduce your lot size, you reduce your risk. Instead of risking consistently in all trades, you reduce your risk, and then you do what? The next trade still becomes a win. Okay? So, or you've had consistently 3 or 4 losing streaks in a row, and you now think the next trade is still the losing streak will continue. You reduce your risk. Okay? If you are risking 1%, you now reduce your risk to 0.25%, and then the next trade after the losing streak becomes a win. Okay, now your win would not, because you've reduced your risk, your win would not cover for your losses, your previous losses. So the gambler's fallacy tries to predict what the next trading result will look like based on the past trading result of past few trades. No, you just have to keep your risk constant. Whether you are winning in a losing streak, risk must be kept constant. Whether you are in a losing streak, risk must be kept constant. Regardless of the time you are in your trading, regardless of your trading result, risk must be kept constant. Risk must be kept constant. You must keep on risking the same amount per trade, or else you mess up your statistical edge. Okay, you mess up your statistical edge. Now, if you are trading your personal account, I advise you risk 1% per trade. When I'm trading my personal account, I risk 1% per trade, because I solely believe in the law of large numbers, and I believe in a game of probabilities. My mindset has been rewired to think in probabilities. Not until you have a mindset that thinks in terms of probabilities all the time, you cannot become a professional forex trader. But if I'm trading a prop firm's account, I risked 0.5% on the account. Okay, so as to make up for so as to avoid the drawdown, so as not to activate the drawdown rule. Okay, in order to obey the drawdown rules. All right, so I risk 0.5% on prop firm's account when I'm trading a prop firm's account. But if I'm trading my personal account, I risk 1% per trade. All right, so let us continue now. There are two fastest ways you can lose your trading confidence. Now, this is what happens most times. You get a new strategy. I see this mostly with new trader. This has happened to me previously when I was in my formative years in trading. Okay, but I still see it frequently in new traders. You get a new strategy, a killer strategy. It could be ICT, it could be demand and supply, it could be smart money, it could be indicator strategy, or one strategy or the other that you feel works. Now, the best to the and mostly you have backtested this strategy and you have seen that this strategy works, but you can as well lose your trading confidence. You can lose your trading confidence. There are two things that can make you to lose your trading confidence. Okay, number one is when you experience a loss when you didn't follow your trading plan. This occurs time and time again. You believe in a strategy, you have done your back testing, everything seems to work fine, but if you break your trading rules by by not following your trading plan, perhaps there are some set of entry rules, entry criteria that you need to tick before, some checkbox you need to check boxes you need to tick before you get into a trade. You did not follow it. If you experience a loss following breaking trading rules, you will lose your trading. Is the one way of you can lose your trading confidence. You become hesitant. You become hesitant to take new trades. Okay, because you did not follow your trading rule. So if you want to keep your trading confidence intact, you need to keep to your trading plan. If you experience a loss even if you obeyed your trading plan, your confidence will remain intact. I'm speaking from experience. You will still believe that the trading system works because you didn't lose by misbehaving, you didn't lose by indiscipline. You lose following your trading plan, and you just discover that it's just a game of probability. Second way to lose your trading confidence is when you experience a big loss due to over leveraging and messing up your statistical probability and edge. When you experience a big loss, for example, you are supposed to lose 1% per trade according to your trading plan, and you risk 5% per trade. All right, and that trade turns out to be a loss. You would ruin weeks and even months and sometimes years of results. Okay, you're going to start afresh again. You need to work on your psychology daily. Psychology is daily. See, in your business, in the secular businesses, whether or not you are in a good psychological condition, your business would work. Your business can continue to work. If you're a trading business, maybe you run a supermarket or a grocery store or a construction company. Whether or not you have a good psychological mindset or framework, no much problems. It won't affect your business so much. But in trading, psychology is a daily battle. You need to continually make sure your psychology is in check every time. If you are a member of my VIP, if you're a member of my trading group, my mentees group, there is something I do most mornings every week. We have some trading meditation which we follow. We have a trading meditation we follow. Okay, some days I post it in the group, but weekly I share our trading meditation. And that the purpose of that trading meditation is to keep our mindset, is to keep our psychology in check. All right, is to keep our psychology in check. Why I share that trading meditation is to keep our psychology in check, because if you over leverage, you lose your psychology. Maybe you experience a loss, the first trade becomes a loss, and then you want to revenge trade, and now increase your loss size, increase your risk by 5% now, and the second that you are more likely to lose that trade. And if you do, you would mess up your efforts of 1 week. Your trading results of 1 week or 1 month or even a year or 6 months can be messed up, and that is not good for the business. So you need to make sure that you keep your trading confidence intact by keeping to the law of probability, by risking consistently in every trade. Okay, if you have 4 or 5 losing trades, just have in mind that you're experiencing losing streaks, and your wins will come eventually. So you think long term. So now let's continue. So you need to do these exercises to boost your trading confidence. Okay, you need to do these exercises to boost your trading confidence. Okay, there are some exercises you need to do to boost your trading confidence. Number one, I would want you to do the toss coin exercise. Toss coin exercise. I do this toss coin exercise frequently. at least once a week from time to time in order to boost my trading confidence, in order to believe in my principles, in order to believe in the principle of large numbers, in order to believe in the principle of probabilities, and to it helps my psychology. Okay, the first exercise will be like to do the toss coin. Take a coin. Even if you cannot find a coin, look for a washer. Okay, if you look for a washer, okay, a boat not washer. Okay, but ensure that there is one of the side can be differentiated from the other. Okay, look for a washer and ensure that one of the sides can be differentiated from the other, or a coin if you can get one. Identify these sides, call one side a head, call the other side a tail, or one side A and the other side B. Okay, so now when you now get the coin or a washer, as the case might be, you toss it. Okay, just throw it up, turn it up, throw it up, allow it to land on the floor. Okay, each time it lands on the floor, mark the side that landed on the floor. It could be the head. If it is the head, you write A, you write H. If it is the tail, write T. Okay, if it is the head, write H. If it's the tail, write what? T. Do that for 100 times. When you do that for 100 times, you discover that you would either get like 46 heads and 54 tails, or 45 heads and 55 tails, or 50 heads and 50 tails, or 51 heads and 49 tails, or just, but it's going to be close to 50-50. Okay, it's going to be very close to 50-50. That would help you. This practical exercise will help you to understand the principle of large numbers and probabilities. Okay, this singular exercise will help you to understand the principle of probability and large numbers. Sorry, my dogs are barking. So sorry about this background sound. My dogs are barking. Now, so when you toss a coin for 100 times, you surely get close to 50-50 head and tail. Now, the second exercise is backtest your strategy for at least 100 trades. Now, backtesting does not mean you have to live trade. Check your strategy across the charts, over the past charts, and see how your strategy worked over 100 previous trades, and you discover that there is a close correlation between the losses and the wins. So when you do a back trace or back test of your strategy, and the times it played out and the times it worked, following a particular entry criteria and exit criteria, okay, following some set of entry rules and exit rules, check on your chart previous occurrences of your strategy, previous setups of your strategy over 100 times, okay, and you can manually record the times it worked out of the 100 times you see your trading setup and the times it failed. When you see that, it will help to boost your trading confidence and help you to understand how many times you help you to understand the hit rate. It's called the hit rate, or the probability of your trading strategy, how many times it could work over 100 trades. All right, these are just statistical exercises. So when you do these two things, it's going to help you. They are going to help you to boost your trading confidence. Now, I want to show you where I did my own. I actually did 2 coin courses before I made this video, so I can show you what I'm talking about. Now, the first toss coin I did. Now, you can see I have a 10, 1 to 10, or each is 10 tosses. These are 10. Number 2, 10 tosses. Okay, up to 100. So if these are each one is 10. All right. So in this first toss, I had 7 tails and 3 heads. Second toss, I had 6 tails and 4 heads. This third toss, I had 4 tails and 6 heads, and it went on and on till I had 100. Till I had 100 tosses. Okay, so when I had the 100 tosses, out of the 100 tosses, all right, now I computed the number of heads I had. It was 48, and number of tails I had were 52 tails, and the number of head streak, which are, you see, number of times I had a consecutive heads 5 times. The highest times I had consecutive heads were 5 times 5. The highest consecutive tails occurrences, you are 6. So now, if this is if the heads are my losing trades, or like, let me assume the heads are my winning trades and the tails were my winning trades. That means and I had a 1:2 risk to reward ratio. If I had won just 48 times out of 100 and a 1:2 risk to reward ratio, this I would have made a net profit if my risk per trade is constant. All right, if my risk per trade is constant, I would have made a net profit if my risk per trade is constant. Do you see how it works? This is the first toss coin I did before making this video. I did the second toss coin. Let me show you the second toss coin. The second coin toss, sorry. Now, I made it in group of tens and 10 times making 100. In this first toss coin, I had 6 tails and 4 heads. Second toss coin also has 6 tails and 4 heads. The third toss coin, I had coin toss. I had 4 tails and 4 heads. The fourth one, I had 5 tails and 5 heads, and so forth and so on. So when I finished the 100 tosses, I had 53 heads and 47 tails, and the maximum number of head streaks were 5. Maximum number of tail streaks were 5. Assuming the lesser occurrences, which is the number of tails, I had 48. Assuming I had 47, the number of tails, assuming the tails were my losing trades, I had 47 losing trades and 53 winning trades. I could have still become profitable if I had a 1:2 risk to reward ratio. Do you see how it works? I could have still become profitable over 100 sample of trades if I had risked 1:2. If I won 2 times the size of whatever I risk, each time I traded, and I just won 47 times out of the 100 times, I would have still made a net profit. But this will not work if you do not risk consistently the same amount of risk per trade. All right, so this is a practical example. I just did this myself. I did this physically using a toss, using a coin. I did this so as to show you how this works. On this principle, profitability in forex trading works, not gambling. Forget about those fake gurus on Instagram and on YouTube trying to tell you how you can flip your a $10 into $2,000, how you can flip $100 into $20,000. That is pure gambling. That is not forex. That is not professional forex trading. Okay, you cannot build a career on gambling. You cannot build a career on having high blood pressure while trading. No. If you want to do this for a long time, you need to have a system over this. You need to have a system. Believe in the principle of probabilities. Keep risk constant. Continue trading, whether losing streak or winning streak. Continue trading. No, just have a mindset. Believe that your wins are always on the way. This is the most important and the greatest secret to profitability in forex trading. If you are in my Forex Telegram group, mentees group, I have a mentees group. If you want to join that mentees group, the link is in the description box. If you want to join that Telegram group, my main Telegram group, you come into our main large Telegram group. When you come to a large Telegram group, you're going to see how you can join our mentees group. Okay, if you see our trading results, we are profitable most of the time. Okay, if you go to we have a separate group where we post all our trading results. You would see the principle of large number working out. This week alone, we made 8% profit. 8% profit. This week alone. Okay, this is this week that ended, that's ending today. We made about 8% profit in our group. And in a month, we have a 10% profit target to make in a month. But this week alone, we just made 8% profit. Does that mean we didn't have losing trades? We had. But our wins covered our losses. All right? So that is how it works. This is professional forex trading. If any other person is telling you any other thing elsewhere, that is gambling. This is the sincere truth about how you can become profitable in forex trading industry without having a high blood pressure, without without losing your house, without losing your life savings, without selling your properties. That is how it works. All right, not until you come to this stage in your trading, you will keep struggling. You will keep struggling. When the market wants to take, allow you to take. When the market wants to take a loss, don't be afraid of losses. The market wants to take its own share, let it take. It's going to give you back when it is your time. Do not fight the market. Don't extend your stop loss. You will incur a large risk that will be hard to recover from. You're not an investor, you're a trader. All right, don't keep losing trades. Don't add to losing trades. Let it hit. Let your stop loss hit. It's just a way of telling you. It's just a way the market is telling. It's the way the market is telling you that you are that setup is wrong. Let it hit. Let your stop loss hit. Let it hit. Don't trade without a stop loss. Let your stop loss hit. When you want to win, the market will give you your wins. You don't have any. You don't force it. You don't force the wins. You don't force the losses. They come. There is a game of probability. They come on their own. Your game, your job as a trader is to take good trades and to keep risk constant and low. You don't determine your wins. The market gives you wins when it wants to give you. The market gives you losses when it wants to give you. But at the end of the day or the month or the week, you should come out profitably if you keep risk constant. I hope I've made this clear. So in conclusion, my friends, learning to think in probabilities is very crucial in your trading success. This is the biggest part of your trading psychology because you must accept and begin to think in a different way than you would naturally when you approach the forex market. Okay, so with these exercises I've shown you and this information, hopefully you will now start thinking the correct way necessary for your long-term success in forex trading. This is forex. This is profitable and a professional forex trading. My friends, I want to thank you so much for viewing this video. Please kindly subscribe. If you're yet to subscribe to the channel, please kindly subscribe to the channel and like this video. Like this video. Please share our videos, like our videos, turn on the notification bell. Turn on the notification bell so that you can be alerted when I post new videos. Please turn on the notification bell so that you can be alerted when I post new videos. Please share our videos too with your friends. Okay, so if you want to join our Telegram group, please, the link to that group is in the description box. I share setups in the group. Like this week, I shared a very nice setup, okay, on I think on USD card that played out perfectly, and people made profits in the group. All right. And if you want me to mentor you personally, you want me to take you by the hand and so that you can become a profitable and professional forex trader, I do offer private one-on-one mentorship program. I don't believe in collective mentorship. I believe in one-on-one training. If I train you one-on-one. I train you. I mentor you at your own pace. Okay, I take you by the hand at your own pace until you become good in the business. So my link, my contact link is also in the description box of this video. All right. So till I come your way next time with a lot of useful content, I want to thank you so much for viewing. Do have a wonderful day. Bye.